Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. Investors tapping the brakes heading into a busy week. Stocks pulling back as the Fed gears up for its policy meeting and a likely rate cut. We look at how today's action could set the tone for the week. The fight for Warner Brothers Discovery goes hostile. Paramount ramping up the pressure and the price tag to take over the legendary film studio. What's at stake and how the battle is shaping up, that's ahead. Plus, the view from the top. Former Cisco CEO John Chambers weighs in on the state of tech and the outlook for the AI trade in 2026. Well, U.S. stocks sliding to start the trading week as Wall Street awaits the Fed's final policy meeting of the year. And Yahoo Finance's Jared Blickery joins us here with the trading day takeaways. Jared.
Thank you, Josh. You might have heard of a little Christmas ditty called the 12 Days of Christmas. Well, we have seen XLK up 11 straight days, so I'm talking about the 11 days of Techmas. And let's just check out what has happened over this stretch. And I don't have a 11-day view, but I do have a 10-day. So here's the S&P sectors. These are all large caps. Number one position is XLK, 8.1%, almost double that of number two, which itself is consumer discretionary. Then number three is communication services. So if you're keeping track at home, that is the mega cap trifecta right there. All three of those outperforming the S&P 500. And what's not doing well over this stretch? Utilities, healthcare, real estate staples, all those in the red. All those are defensive. So this is, it's almost like the old days of the bull rally. Maybe the AI trade is back. And to further that hypothesis, let's go to my leaders. And these are a bunch of ETFs, a basket of ETFs that I use to kind of gauge sentiment in the market. In the upper left there, the top one is SOX. That is the Philly Chip Index. That's up 15.5%. Number two is Quantum. That's arguably another tech trade. ARK is disruption, a lot of tech stocks in there. IPOs is, that could be anything, but a lot of times it's tech dominated. IWC is microcaps, so that's an outlier. IYT is transportation. Then we have software, that's another tech dominated industry, and then retail. So you put it all together, tech is driving this rally once again. So I'm sure we'll see concentration headlines in a little bit, but that's what we got working for us right now.
Here's another question.
Yes.
Top of mind. Fed meeting on deck. We expect a cut. Yields on the long end creeping higher. What do we make of that?
Well, let's take a look at those long rates that are creeping up right now. And we'll do that with the 10-year T-note yield. So this is something that's been happening day by day over the last few days. We can see that the 10-year is up 3 basis points today. That's how you read this right here, that little 3. That's 3 basis points. 4.17, it was 4.14% yesterday. Here's a 5-day look, and you'll just see day after day just creeping steadily higher. It's not a huge deal in terms of the year to date because we can see this is just a lot of chop in here, so we're not even at an extreme. And what usually causes problems for stocks is when the bond market moves really quickly. And you will see that reflected in the VIX of the bond market, which we look at sometimes called the ISB of a Move Index. We'll take a look at that in a second, but that's pretty muted as well. So that was a 10-year, and now let's take a look at the 30-year. 30-year is at 4.82%. Now, this is interesting. It just cleared its 200-day moving average. Sometimes when a market does that, you get a little momentum to the upside, but still, kind of similar to the 10-year, we are still well within the year's range. So we are not in an extreme. What causes a problem sometimes, the level that causes a problem in the 30-year is above 5%, but we're not close to that just yet. As promised, here's the VIX of the bond market, ISB of a Move Index. I'll take away that moving average, and you can just see we are camping out by the lows. So that is less fear. That is good for bonds. That is good for stocks.
I feel like you want to talk about Santa.
Oh, yes. It's a theme. So let's talk about Santa's indicator. The Santa Claus rally is actually an indicator, and we had the opportunity to talk to Jeff Hirsch today on Stocks in Translation. Episode drops Tuesday morning, so check it out. His father, Yale Hirsch, either created or discovered the Santa Claus rally as a seasonal pattern in the early 1970s. And it's part of a trifecta of indicators that they will use. Well, now it's just Jeff Hirsch. His father has passed on, but he will use so that by the end of January, you have a pretty good idea of the S&P 500, where it's going to close in December. Do you have gains or do you have losses? And so let's take a listen to what he has to say about the Santa Claus rally.
It's an indicator, it's not some year-end trading strategy. And what happens during that period of time is usually a lot of people are off, and the pros are in there picking up bargain stocks were sold for tax loss selling, and the market tends to be up a modest 1.5%. And when it's not, it's an indication that there are other forces that are at play, that things might be awry. So as Yale, the phrase that he invented or that he coined was, if Santa Claus should fail to call, bears may come to Broad and Wall.
All right, Jared, thank you, buddy. Appreciate it. Stick around, much more Ask for a Trend still to come. Breaking news, President Trump announcing a deal with China to allow Nvidia to sell its H200 chips to approved customers. And tech editor Dan Howley is here with more. Dan.
Yeah, Josh, he just posted this on Truth Social saying that he's approved the sale of the H200 chips to China, that he spoke with President Xi, and that he seemed to respond as though this is going to be a deal and move forward. He said that the U.S. will now take a 25% cut of sales to China. That's up from the 15% cut that the president had originally bandied about. He said this also applies to AMD chips as well as Nvidia chips. He blames the Biden administration for putting together the prior plan about degraded chips, although it's worth noting that he kept that in place for some time. President Trump, that is. And so this is kind of this ongoing back and forth. Now it's really up to China to respond as to whether they'll officially allow these chips to be imported into China. The H20 is available for sale there. It's just or to be exported. It's just that China doesn't want them because they're not powerful enough. And so we'll have to see. This is the H200 again. It's not the Blackwell chip, the B200 and 300. This is based on the older Hopper architecture. And so it's a generation behind. So, it's not going to be the most powerful. And we'll have to see if China is accepting of that. But as I said, Trump seems to say that Xi has responded positively.
It's interesting, Dan, because the Journal makes a point early this year, and I think we talked about it when it happened. And Trump approved the H20 exports to China, and then China weighed in, and they were alleging security concerns. And some had said, well, maybe that was sort of a negotiating ploy tactic to get to the H200. What do you make of that?
Yeah, I mean, it seems to be the case that they were pushing more for the H200. It is a very powerful chip. The H20 is basically a version of that without as much processing capacity. And so this is going to be basically what was available, as I said, in the prior generation. Right now, they're shipping the Blackwell Ultra. Prior to that was the Blackwell, both based on the same Blackwell architecture, and then they have prior to that the Hopper architecture. And so this was the most recent version of Hopper that they had available. And so NVIDIA is also going to be moving over to their Rubin architecture next year. And so you can presumably, they'll have a Rubin Ultra after that. But, I mean, this is a big deal. As I said, as long as China agrees to it, then it would mean that those chips would be going over there. However, there has been a lot of pushback. There are China hawks who say, look, you're giving an adversarial country access to high power AI chips that they could use to develop AI programs that would unseat the U.S. economically or militarily. And so, there's going to be back and forth debate as to whether this is a positive or negative. But for now, it appears to be a positive for NVIDIA.
Dan, thank you. Appreciate it. Time now for to watch Tuesday, December 9th. We're going to start off on the earnings front. More reports coming in on Tuesday, including AutoZone, Campbell's Soup, and GameStop. Campbell's reporting first quarter earnings before the markets open. Analysts expecting Campbell's sales to fall 4 to 5% this quarter because of an unusually strong year last year. The company is also dealing with tariffs and higher marketing costs. Taking a look at the labor market as well, we're going to be getting a read on small businesses on Tuesday with the NFIB Optimism Index. Economists forecast the November number to edge slightly higher to 98.3, signaling a wait-and-see mood among small businesses, and that owners feel about the same level of confidence and concern as they did in October. Sticking with labor, the October job openings and labor turnover survey is coming out on Tuesday. Job openings expected to hold steady at 7.2 million compared to August. Remember, September data not released due to the government shutdown. The new data signaling no major shift in hiring momentum and demand for workers is stable. Well, all eyes are on Oracle earnings out on Wednesday as the software giant's results are looked at as the next bellwether for this AI trade. Former Cisco executive chairman and CEO John Chambers joined opening bid to talk about Oracle and the rest of the AI trade.
In terms of the major players, whether it's the Magnificent Seven your prior guests talk about, or Oracle, Broadcom, obviously I'm not referring to the quarter at all. I tend to think for the year and 2 years out. I've learned a couple lessons. You never bet against the Fed. If it's lowering rates, you're probably going to see an up market. And don't bet against Larry Ellison or Hawk. And both of them, I think, are tremendous leaders. In terms of the players I love in this area, I like what Google's doing, and probably they've improved the most in the last 6 months on their hand. And then Microsoft, Satya's doing an amazing job. And then I like Lisa at AMD in terms of that group that I think are really making a difference there. But indications of what you just said, I would not look at one company as the bellwether. In the internet, that was fine, where Cisco had 50 or 60% of the business, and we often had the vast majority of every product category. But if you watch what's going on today, whether it's in semiconductors, whether it's in the software, the models, etc., you'll probably see a couple of the Magnificent Seven stumble over the next year or two. And I hope the market doesn't overreact to that. I think you need to look at the balance of the group. The balance will be up. But I think whether it's the Magnificent Seven or startups, you're going to see that mid-level group, several of them fall out at a fairly rapid pace, especially some of the smaller companies.
Who do you think stumbles, John?
The ones that I like to bet on Microsoft and Google. I think they're positioned well in terms of it. Nvidia, Jensen's a machine. So those would probably be my three that I like the best.
I've never seen a backlog like Larry Ellison has at Oracle. I think it was $455 billion. But the stock has been under pressure because of fears that they can't actually service that amount. If you were the CEO of top of one of these large AI companies right now, John, how would you finance some of these big deals?
Well, I think the money's there as long as the market sees it. Financing in today's world, the market, if they really believe in your strategy and the implications of it, the financing's there, and that includes for venture capital and startups. Financing, if you haven't got a good plan or concern, it can be a little bit more challenging. But the AI play, I believe, is real. I do not believe it's a bubble. I think there will be people that trip within that, and there'll be some train wrecks. But the AI play, we're just getting started on. I think 2026 will be a great year for AI. Productivity will grow faster than almost anybody realizes. I think the market's underestimating that on earnings. And I think many of the CEOs are just getting started on how they're going to use AI in a major way. It doesn't matter whether you're in retail like a Walmart, or an automotive like a Ford, or in healthcare or government. You're seeing AI benefits start to occur real rapidly. It used to be just in coding and customer service. Now it goes across all functions. So I think this is a decade-long phenomena, and I like the play of taking the top players, bundling them together. I personally like the hot startups, the companies I've been fortunate enough to be associated with, very much like what KR is doing at Bloom Energy, or what Bipple is doing at Rubrik.
Yeah, I just talked to Bipple last week. I mean, another big quarter from them. Big IPO, too. What, everything I've heard the past month, John, everybody's been so enthused with Gemini 3. And look, I mean, it's a powerful model. What Google has done over there has been tremendous. But is the market now underestimating the potential for OpenAI? I mean, this company has huge, lofty ambitions over the next decade. They have a lot of commitments out there. And if they don't deliver, I mean, it's just not good for the tech ecosystem.
Well, first of all, I think it's very healthy to have two at least, and you prefer three players in a category. I think both those companies are going to do very well. I've been really impressed at how Google has moved, as I alluded earlier, in the last 6 months. And what you do with OpenAI, I actually did my 10 predictions for this year, and I didn't use any of the AI tools, but I went out and asked the questions on each of the 10. what did ChatGPT say and what did Gemini say, and the odds of me being accurate on it. And then I said, what is the one or two area on each of the predictions you think that I'm most exposed on? The answers were amazing. So I think you've got two great tools. You're going to see people move back and forth in terms of utilization of them. And I think both of them are going to do fine. But again, just starting to see early innings of what this is going to produce.
Are you concerned that OpenAI is at the core of so many big deals? I mean, you mentioned AMD. I mean, they had a big deal, and OpenAI might be an investor with them looking out over the next 10 years.
Well, if you watch, what I think we've seen this time is normally the large players do not participate in the next generation of market movement. That was true of IBM, mini computers, client servers, the internet, software service, the cloud players. This time it's going to be exception. They're going to be there. And if you watch the model that we did at Cisco in the very early 90s, you do it yourself. You do it through acquisitions. I did 180 acquisitions, or you do it through strategic partnering. So I love the strategic partnering that many of the companies are doing. And actually for my startups, whether it's Nvidia or whether it's AMD or others, they're investing in the startups because they're driving their own core business, the implications. I think it's a very good strategy. It does show that if one company trips a little bit, it'll affect others. But I think in terms of accelerating the market, it'd be what I would do if I were in their position. And whoever wins the AI battle as a nation and as an industry will lead GDP growth, standard of living, etc. So I think it's a national priority, and I like it a little bit. It would be an understatement. I like their strategy. Do it yourself, acquire, strategically partner, invest. I think it's just smart.
Stick around. Much more As for Trends still to come. The drama of the takeover of Warner Brothers Discovery is something out of a movie. David Ellison and Paramount Skydance taking their bid hostile directly to shareholders and raising the stakes by $18 billion. Netflix co-CEO Ted Sarandos speaking out earlier this afternoon, calling that move entirely expected, and says he's confident his deal will get done. Joining me now is Mark Boidman, Solomon Partners, head of media and entertainment. Mark, it is great to see you. So the drama does continue, Mark. Paramount launches the hostile bid for WBD, $30 a share, all cash. What do you make of this move by Paramount, Mark, financially and strategically?
Yeah, it's interesting times. Whoever ends up owning this company, or these assets, I should say, is going to really create the future of streaming. So it's an important asset to own. It's going to set the future of where things go. But most importantly, what it's going to do is transform the media industry as we think about the future of media, how and what content we get to see. So we're excited by seeing activity. We're excited to see that, the auction process has evolved, and it's exciting to see what happens next.
Paramount, Mark, in part is making its case that, listen, our deal will be easier to get past regulators. Do you agree with that?
I think what I would say is the regulators are going to have to really look at what the definition of these assets are. Is this a streaming definition? Are we going to look at streaming? Are we going to look at a broader media advertising audience or a media consumption audience? Because if you think about this from an advertising perspective, Netflix and Paramount both have advertising businesses that are relatively small compared to the advertising pie. And then when you look even more narrow wider, and you look at the media industry on a wider perspective, you say, well, look at this compared to other companies in the industry, whether those are tech companies, media companies. Think about companies that do social media. Their audiences are far, far larger, billions, compared to a combined Netflix and HBO Max, if you put those two businesses together. Or if you look at Paramount and you put its business together here, same thing. The audience size is pretty small. So in terms of control, in terms of other things that we think about as we think about competition, if you define the market quite broadly, less concerned. If you define the market quite narrowly, just as it relates to streaming, well, certainly it may cause some people to rethink this.
I'm curious, Mark, where you think all of this drama could leave Brian Roberts and Comcast. How does it shake out for them? And are you surprised, Mark, that maybe Brian Roberts didn't get the deal done with Zaslav and WBD when he had the opportunity?
Yeah, I think what you're seeing is when buyers go directly to shareholders, the process works, right? So you have a situation where you have a deal. If Netflix ends up in a situation where they're not the prevailing party, they'll be paid a fee. If they end up as the prevailing party here, then I think you will see some others make other strategic moves. So this is going to create, as I said, the future of media and tech as it relates to media consumption, choice. And so parties are going to say, well, what do we need to do if they're not the prevailing party? So you mentioned other diversified media and tech companies, whether it's Comcast or others, they're going to be thinking through their next move. So regardless who ends up with these assets, the next question is, what should we be doing? In fact, they're probably already thinking through that today. And while we may not know the answer of who's going to own these assets for 18 months, there's certainly lots of other assets out there that would make for interesting acquisition targets. And this transaction sets a valuation benchmark. It's a good data point for how diversified media companies should think about assets in the marketplace from a valuation perspective, but also from a strategic priority perspective. Because if this deal happens, and when it happens, you will see a transformed media landscape, which in theory causes people to rethink what they need to do.
Finally, Mark, I know if you saw this, David Ellison was talking to CNBC this morning, and he was making the case. He says, if Netflix buys WBD, he says, it's the death of the theatrical movie business in Hollywood. You hear those comments. What's your response, Mark?
Yeah, I mean, there are plenty of other studios out there, so I'm not sure I fully agree with that. But having said that, we know that Netflix has different thoughts around viewing windows, trends, how they think about the business. So they may react in certain ways, or people may react to Netflix coming in and buying these assets, as that this may cause those types of pressures. But I would say that this is an evolving landscape, and we are seeing cinema come back from post-COVID in a nice way. Obviously, having more choice for the consumer is better. So having more choice when it comes to seeing content in theaters is a good thing. I like to see, when I want to take my family to a movie, lots of choice out there. So obviously it's a better thing. And I think Netflix is committed to producing cinema quality content. It's cinema content to be shown in theaters.
Mark, always appreciate your time and insight. Thank you.
Great to see you. Thanks so much.
That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet.